In the world of investing, one of the most important principles that you can learn is the concept of a margin of safety. A margin of safety prevents you from making large investment mistakes and over the long term allows you to make investments that are a lot more profitable. In this video, I'm going to share with you how it is that you can apply the concept of margin of safety to make way more profitable investments over the long term, and also practically how it is that you can apply this principle from an investment perspective. Okay, so to understand the concept of a margin of safety, it's very important to have a good grasp on the concept of stock valuation. But before we get into all those words that sound a little bit complicated, I just want to simplify the concept for you so that you have a really solid idea of how this works. So let me just go here into another tab. So we have a whole bunch of companies and we have some of their key metrics, some price data here, so we can always refresh them and whatnot, right? So in this case, we can see the price was outdated for Apple. Currently, at the time that I'm recording the video, the stock price is trading at $184 per share. So let's say that somehow, some way, you got some divine intelligence and you were able to get the value of Apple as a business. And that is the first concept of a margin of safety. The fact that when you invest in these companies like Apple, Tesla, Amazon, Microsoft, you're not investing in a piece of paper, but rather you're having part ownership in these companies. So when you have part ownership, that basically means that you're investing in these companies. And you could even think about if you were investing in these companies as a whole. So if somehow, some way you were able to know that, let's say Apple as a business was really worth $250 per share. So let's say this was the actual value. What you could then do theoretically is buy right now, buy the stock right now, buy as much as you can right now, because you know that it's worth 250. So that way you would make profit, right? So you would be able to buy 184 and sell at 250. So the profit would be the 250 minus the 84. So this would be $65 per share. Times that for the number of shares that you own, and this would be your profit, which would be really, really nice. Now, the key question is, how is it that you can determine the actual price of Apple and for all these different stocks and companies that you can see right now? Well, that is where the art and science of valuation comes into place. There's many different ways to value companies, and it really depends on the industry, the company, and whatnot. One of the most common ways is to use something like a discounted cash flow, which allows you to find the value of a company based on the future cash flows of the company. Now, where the concept of a margin of safety comes into place is that if you knew with 100% certainty that the stock was worth $250, what is the maximum price that you would be willing to pay for the stock? Well, theoretically, if you knew with 100% certainty, you could pay $250, right? Or you could pay $249 so that at least you're making $1 of profit. However, in the real world, there's no perfect intelligence and we don't know 100%. Nobody knows 100% what a company is worth. Therefore, what you need to know is have a margin of safety, which means have a margin of error where even if you're wrong, even if your assumptions are wrong, you can still make profit. So typically this is like usually about 20-30% margin of safety. So that means that if you really think the stock is worth 250, you would basically discount the 30%. And this would be the maximum price that you should be able to pay for this company. Now, you could have a higher margin of safety or you could have a lower one. The higher the margin of safety is, the better it is for you as the investor. However, the problem is that companies that trade at a huge margin of safety, they're not very good companies or they're very rare to find. So that is usually the issue. This is why usually a 20% to 30% margin of safety is used. And this essentially protects you so that you don't make bad investment decisions. So let's say that for some reason your assumptions were wrong, and you know what, the stock is actually worth $230 per share. You bought at $175. So guess what? You're still making profit, and the profit would be the difference between the 230 and the 175. So you would still be making $55. This is why the concept of a margin of safety is very, very important, because it protects you from these losses and it allows you to make reasonable assumptions and still come ahead even if you're wrong. So now what I want to do is kind of put this all together and show you how the concept of a margin of safety really comes into place in the real world. So we have these numbers here. We're going to get rid of this. We're going to go to our DCF model and we're going to change the company from Apple to Microsoft. In this case, I'm using Y-Sheets formulas that you can see right here to automatically update the historical data. So in this case, we're looking at the financials, income statement, balance sheet, cash flows, and whatnot. As you can see, once you change the company ticker, all the data will update. So we have the information here. And then this is where it really becomes very important to do your own research. So as an analyst or an investor, what you would do is make different assumptions in terms of the growth or decrease of particular items of the financial statements. In this case, we're really looking at revenue. So you would change the assumptions based on your own research. And then after you make all the assumptions for all the different items of the financial statements that really matter, mostly the ones that you can see are in green, then what you would do is be able to project the future cash flows of the company. And then based on the future cash flows, then you can find the present value of the company or the price per share. So in this case, we can see that according to these assumptions, by the way, these assumptions are wrong. They're not my actual assumptions. They're just an example. We can see that the current actual price that the stock is trading at is $337. And according to our DCF, guess what? The price per share should be $4,112. So obviously the number's wrong. But if this was the case, this would be a heck of a potential investment opportunity, because you would be able to buy something that's worth $4,112 for only $337. So this would be an amazing deal. And based on this, you could have a potential return of 1,117%, which would be absolutely ridiculous. But you get the idea. This is what you need to do, and this is kind of how valuation works. If you want, you can check out many different videos that we have on our channel on the art of valuation, but there's also some really good ones on YouTube that you can find as well, how it is that you can value companies. And then after that, it is very important to apply the concept of a margin of safety so that after your valuations, you can still come ahead and find good investment opportunities. One last thing that I want to share with you is that if you want to get this DCF template that you're looking at right now, as well as be able to download a whole bunch of other really powerful valuation templates, you can find them all right here on the Y-Sheets add-on. So this is an add-on that works on Google Sheets and Excel, and from here you're gonna be able to browse and download the templates that really matter to you. So in this case, we have an earnings power value model. This is another really powerful valuation model. We also have the DCF, as well as many other different templates that you can download for free and then modify to be able to adjust for your particular investment style. Now you know everything that you do need to know about the concept of margin of safety and how to apply this very important principle. So be sure to use this information so that you can make better stock investment decisions for yourself and for those people that you most care about. And if you've enjoyed this video, make sure to subscribe and turn on the notifications on so that way you get notified every time we release a new video like this that's gonna allow you to take your investing game to the next level. I'll see you in the next one.